Good afternoon, everyone. Welcome to another training session from Hot Forex. So I'm Andrea once again. Today we have a really fundamental webinar. So we're gonna go through what central banks are, what they actually doing, how they will affect the market with their interest rates, with the monetary policy that they are following, and etc. So it's a fundamental. It's not a technical webinar, but more or less a fundamental one. And since the central banks have been in focus for the last 2 years since the pandemic outbreak, it's good to remind you occasionally the importance of central banks the importance of central banks and how they could affect, even though I think that you already know that. I mean, the market not lately, the last year, more than a year now, has been driven by the expectations of central banks actions. So that's what we're gonna see today. So before I move on, I would like to make sure that you can hear me loud and clear as usual, okay? Until you reply to my question in regards to the audio, I will go through the disclaimer. So please, any one of you, confirm me whether you're facing any audio or visual issues, okay? Until I go through the disclaimer warning. I would like to remind you that this webinar is being recorded. So at the end of the session, the latest by tomorrow, you're gonna receive the recording as well. I have already uploaded the PDF file of the slides, so feel free to download it from the handout section in the GoToWebinar page. So, disclaimer. This material is provided as a general marketing communication for informational purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling for any financial instrument. All information provided is gathered from reputable sources, and information containing an indication of past performance is not a guarantee or reliable indicator of future performance. User knowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. A risk warning: trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full disclosure in our website along with all the legal documentation that you might want to see. So guys, can anyone just quick stick on the question box feedback in regards to the sound and in regards to the screen as well, whether you can see my screen. Please don't forget that for any further questions after this session, you can find me at webinars@hotforex.com. So feel free to send us an email. I will try to reply as soon as possible. Anyone, a quick feedback for the audio? Okay, I will keep talking so not to lose time until I have a feedback from you guys. Let me check the audio as well. Audible. Thank you, Felisa. Thank you very much. So, what we're gonna see today, we're gonna see what central banks are, what they do, and how they can affect trading. And obviously, questions and answers at the very end of the session. You can ask anything you want anyway, and interrupt me if you want, and I will try to reply in the middle of the session. So, as I've said, a fundamental topic, not a technical topic, so you can understand there will be a theoretical one. What central banks are? First of all, before I move on to what they are, I will highlight this point that the very, very, very first central bank in the world was established more than 400 years ago. So 1668, the first central bank to be established with ongoing operation was the Swedish Riksbank, 1668. The second one was a bit later, I mean, nearly 300 years later, the Bank of England, 1964. Just because I found it a bit interesting, that's why I put it on. So what is a central bank? Central bank, guys, is an institute, okay? It's an institute which actually has the privileged control over the production and distribution of money and credit for a nation or a group of nations, okay? Central banks act as the banker and the trustee of the government. So especially if we are referring to raising money. Okay, so this is very, very briefly what the central bank is. In the modern economies, central bank is usually responsible for the formulation of monetary policy and the regulation of member banks as well. But before I move on to that side, I mean to the formulation of monetary policy, here I put in I have put some bullet points on what's the objective of the central bank. So as I said, it's an institute, okay? So main objective is on the control of over the production and distribution of money. So based on these lines, it's also managing each country's currency, money supply, and interest rates as well. Here's where so interest rates are coming. Okay, so other than the fact that it's responsible for production and contribution of the money of each currency, it is also responsible for the interest rates, okay, along with the observance of the monetary system and policy of a country. Okay, so the one that is responsible for setting interest rates is actually the central bank, not the government. Okay. Okay, so the central bank usually also prints the national currency, okay, which usually serves as the state's legal tender. So this is actually significant. Why is that? Because have in mind, okay, that's a bit tricky. I understand money that. So we said that responsible for producing and distributing the country's currency is central bank. So they're literally printing money, right? So that's the way they have invented in order to control the monetary policy. Sorry. So monetary expansion of a country could not occur simply from a political decision, okay, to print more money. But it's the printing of more and more money is also a part of it. But the central bank is mainly responsible for maintaining the value of that country's currency. And it can achieve that. One way to achieve that, okay, is this printing of money, as we said. So the printing might sound a bit odd. It might sound weird, but it's of huge importance, especially if you compare it with other potential currencies such as cryptocurrencies. Bitcoin. So we cannot print Bitcoin, right? It's been stored in the cloud and etc. But it's not. You cannot really take it on your hands. Okay, so that's why there is a monopoly over the supply of money. Each central bank, each country, the central bank of each country has a monopoly over the supply of money that he produces. So the Fed, for example, in the United States prints dollars. So it's having a monopoly over the dollar. ECB has a monopoly over the euro. Okay? Means that the central bank cannot run out of money because it's the one that produce and supply and distribute that particular currency. Let's move on. Okay, so a bit of a history how we end up with banks printing money, monitoring the monetary policy of a country, controlling the inflation of a country, and be responsible for stabilizing the value of a currency. So, okay, a bit of a history, as I said. Oh, sorry. So, first of all, just to highlight that the responsibilities of a central bank is not just to print money. Okay, there is a wide range of responsibility, depending, of course, on the country. But the responsibility, the main three categories that the responsibilities, the duties of the central banks are falling into are firstly to control, as we said, and manipulate the national money supply. Okay, so issuing the currency, setting interest rates on loans and bonds, raising interest rates to slowly grow and avoid inflation. Okay, so that's the one way. This is the way they manage monetary policy to guide the country's economy. The second duty that they have is to regulate member banks through capital requirements, reserve requirements, so which dictate how much banks can lend to customers and how much cash they must keep on hand. Also to regulate the deposit guarantees and some other stuff as well. They also provide loans and services, as you know, for other banks. So we have the central bank, but in every country we have the national banks, right? I mean, I don't know for you guys, but in Cyprus we have the Central Bank of Cyprus, but beneath that we have other individuals. So we have member banks, Bank of Hellenic Bank, Ancoria, Eurobank, and etc. So these are member banks under the regulation of the Central Bank of Cyprus. So if I want a loan, for example, I will go straight to one of these banks. I will not go to the central bank. I will go to the member bank. So the central bank regulates member banks and deposit guarantees. Okay, so and finally, the central bank also acts. So remember, like having meant that the central bank acts as the parent of all the other banks. So each country has several banks, but they are all under the regulation of the central bank. Okay. Also, the central bank acts as an emergency lender to distressed commercial banks and other institutions, and sometimes even a government. So if something happens and a bank needs a loan, then it will go to the central bank in order to ask for a loan. If the government if something happened with the government and it needs money, they will go to the central bank and to borrow money. So by purchasing government debt obligation, for example, the central bank provides a political attractive alternative to taxation when a government needs to increase revenue. So, oops, yeah, so we have, sorry guys. I skip a slide. This is what we have, what we said just now, the lender, lending the government, lending the other banks, and etc. But I skip one last bit. I skip a bit of a history, a bit of a briefing, a bit of a history of the central banks. So remember, like before we actually have currencies, people were used to trade to trade with goods. So if I had apples and the other person had I don't know, wood, and I needed wood to build my house, I had to exchange my apples with wood. So it was that way. Afterwards, the very first thing that was used as a currency was gold. Okay, so the very first central banks, as I said, that they were established was the Bank of England and the Swedish Riksbank back in the 17th century. So the Bank of England was the very first to acknowledge the role of lender of last resort. Okay, so lender of last resort is the one that I've just. So what we mean by lender of last resort? Lender of last resort is an institution, usually a country's central bank, that offers loans to banks or other eligible institutes that they are experiencing financial difficulties. So yeah, the central bank, as a definition that we know it today, it has been established by the Bank of England initially. Okay, so they have invented this term called lender of last resort, which is actually is the central bank, is the institute that is offering to other banks, eligible institution, loans. So in United States, we have the Fed, which acts as a lender of last resort to other institutions and other banks. So let me take a step backwards. Other early central banks, like Napoleon's Bank of France, was established to finance expensive government military operations. So back then there were, don't forget that was the World War back then, and not back then, but I mean initially the banks were established to finance the war. So it was principally because European central banks made it easier for federal governments to grow, wage war, and reach special interests that many of US founding fathers like Thomas Jefferson opposed establishing such an entity in their new country. But I'm telling you a lot about history, and I don't think that's that's so interesting. But nevertheless, eventually, uh, um, uh, eventually we have seen this split between the national banks and um, the state chartered banks, mainly in the US. So and eventually in the late 18th century, we have seen that a network of national banks has been created under the observation of the Fed. So we have the Fed, which is the Central Bank of the United States, and beneath that we have a network of national banks with a single US currency, okay, as well. So in the United States, we have experienced, we have this kind of formation. Um, the Fed, which has been established by the Congress in 1913, and below that we had the regional banks throughout the country to stabilize the financial activity and banking operations. So the new Fed helped finance World War I and World War II by issuing treasury bonds. Unfortunately, this is the history. This is the history of the market started due to the wars. So between 1817 and 1914, when world currencies were pegged to the gold standard, maintaining price stability was a lot easier because the amount of gold available was limited. So monetary expansion could not occur simply from a political decision to print more money, so inflation was easier to control. So the central bank at that time was primarily responsible for maintaining the convertibility of gold into currency because because the money had to be backed with gold, something that it wasn't practical. Okay, so at the World War II, um, at the World War I initially, we have seen the gold standard that it was abandoned, and it became apparent that in times of crisis, governments facing budget deficit and needing great resources would order the printing of money because it was more practical. But during the World War, while the countries were doing that, they have identified that it wasn't practical and that actually they did not encounter the inflation. So many banks, many government actually after that opt to go back to the gold standard to try to stabilize the economies. Okay, so this is how we moved from the gold standard into how we are we're seeing the central banks behaving right now, like are getting rid of the gold standard as we used to. Sorry for that. As they used to, because yeah. So I said a lot about the history of and the bad of gold standard. I think I should move on and let's see. Let's move on. Come on. We have also okay. Let's see, however, how do they do all these functions, how they proceed, and how these functions are actually affecting us and affect the markets as well. So let's move on. Okay. So modern central banks. As I initially said, the main function of a central bank is the control of supply of money through the manipulation of interest rates, right? So this is what this is the main role, if we can say, for central banks. Okay, so as I already mentioned initially, in every economy has its own central bank, which is responsible for controlling that country's currency and keeping it stable. So there are two ways of doing something like that. The first way is by controlling and amending the interest rates, either for a loan, either for borrowing, but also by the monetary policy. So So any manipulation of interest rate actually affects the monetary sector. And this is called monetary policy. Okay? Monetary policy. Let me just monetary policy. So just to briefly inform you what the monetary policy is. By saying monetary policy, we are referring to the strategies employed by the central bank with regards to the amount of money circulating in the economy and what that money is worth. So remember, the main objective of a central bank is the growth of the country's economy, right? So for achieving this long-term economic growth, central banks um, uh, are setting some goals. Okay, and this can be achieved by amendments in their monetary policy. So, for example, in the United States, we have the Fed, right? And the Fed's reserve monetary policy goals are they are really focused to promote maximum employment, stable prices, and moderate long-term interest rates. Okay, in a different country, Canada, for example. Bank of Canada, the Central Bank of Canada, as a main goal, has to keep inflation at a certain level, let's say 2%, based on the view that low and stable inflation is the best contribution that monetary policy can make to a productive and well-functioning economy. So you see, every single central bank has different goals. But one way to achieve their goals is with the amendment of monetary policy in order to achieve a long-term economic growth for their countries. Okay? With this way, with the monetary policy, they can also achieve indirectly to affect the macroeconomic development, such as inflation and the gross domestic product growth as well. So let's do a bit of a summary on what the central banks are doing. So central banks, as we said, they are known as lender of last resort. Okay, firstly, providing emergency credit to financial institutions that are struggling financially and near collapse. Okay. Also, it acts as a banker and trustee to the government. Okay, let's not forget that. So they can even provide loans to the governments, right? Okay. Also, one of their main responsibilities is to issue and control the quantity of banknotes. So it's to the production distribution, as we already said, of the country's currency. Okay. Also, they typically act as the lender of last resort, as I already mentioned, to banks that no longer have other available means of borrowing, or either they have failed to obtain credit and they could affect dramatically the economy. So they're trying to rescue, if I can say this term, in order this bank not to affect the main economy. Okay, is the bank of commercial banks. Also controls the money supply through monetary policy. It's also responsible for financial oversight and many other functions. What I haven't forgot that. I forgot anything back. We have said about the interest rate. So when the economy overheats, central bank raise interest rates and take other contractionary measures to slow down things. okay? Or even if we are facing a recession, an economic recession, in particular, bank, the central bank is responsible to act by getting lower the interest rates and to add more money, to print more money, and to add more liquidity to the economy in order to um, support the country's economy, and it can do all this, as I said, by amending, taking actions, and by amending the existing monetary policy. Let's move on. So I tried to explain as much as I could the monetary policy, but if there is anything, because it's a very, very long topic, if there is anything that you're struggling you're struggling with it, just let me know right now, guys, okay? But in short, what you should know about the monetary policy is that the banks, the national banks in every country, tend to borrow either from the central bank or from each other in order to cover their short-term financing needs. So the policy interest rates not only defines the overnight lending rates that banks will pay to the central bank when they borrow from it. Okay. Um, any questions so far, guys? Because it's a bit of it's not a straightforward topic. Actually, explaining monetary policy is a very, very long topic, and I touch it slightly, so you might want me to go a bit in deeper. Okay, if until you have any questions, I will get a bit deeper just to explain a bit the importance of of uh, of um, of monetary policy. Having in mind that for you as traders, it's very, very important to understand the monetary policy because it can have a significant impact on the markets, and we're going to see how it could have an impact. But having in mind that monetary policy can be restrictive, so tight, contractionary. It could be, however, accommodative, so more loose, expansionary, or it could be neutral. Neutral is what we see in Japan for many, many years now. So by understanding the monetary policy, you will understand also the long-term outlook for each country's currency. So have in mind that when the economy is growing too fast, okay, something that we are seeing this year with the inflation actually in the US, not elsewhere, we're seeing a really fast economic growth with the inflation moving higher. So the central banks, if this is something like that, they need to take steps to cool the economy. And one way of doing that is through a very tight monetary policy. So a tight monetary policy means to raise short-term interest rates. So on the flip side, when a country is not doing well and it's the economy is sluggish, once again the central bank needs to interrupt and needs to adjust its monetary policy, but this time to set a more accommodative policy. So what I mean by set accommodative policy, accommodative policy we're referring when the central bank will need to adopt lowering short-term interest rates to stimulate growth and to get the economy back on track. So you understand that these actions, these changes of the monetary policy, they affect the investments in a country. So they have direct impact on the investments. So direct impact to the markets. They can affect, the monetary policy can affect equities, bonds, cash, real estates, commodities, and currencies. Okay, so cannot see any questions, so I will move on. Okay, I will move on. So The central banks is not the only tools. We discuss about interest rates. We discuss about um, uh, monetary policy, but they have plenty of other tools in order um, um, to control, if you prefer, the market. Okay, so they have a lot of monetary policy tools, but there are only three main policy tools. The very first includes the purchase and sale of financial instruments by the central bank. The second one is the interest rates that we have already discussed and changes of the interest rates for a short-term loans, long-term loans, etc. The third one is the reverse requirements or the proportion of deposit that banks must maintain as reserves. Okay, these are the three main policy tools that the central banks has in order to influence monetary policy. So let's start with interest rates as a tool. And let's assume that for a particular country, I will keep that very generic. Okay, let's assume that a particular country, the central bank of a particular country, has increases interest rate policy rates, to be more precise, by 1%. Okay, so the policy rate has increased by 1%. If banks do not increase their own rates accordingly, a single bank could actually raise its rate by, say, 0.25% and receive an influx of deposit. It could also lend back to the central bank and enjoy a hefty profit from the 0.75% difference, because it's the 1% minus the 0.25% increase that we have seen in the deposit rates. So all of the banks will seek to do the same thing, right? So this will have as a consequence the bank rates to increase. So as this happens, deposit rate would also increase lending rates as well. So we're going to have an increase of the lending rates along with the deposit rates. So by the increase of deposit rates and lending rates, with this increase, then we're going to see um, uh, this increase will affect the um, the public's inclination to borrow. So this increase of the lending rates or deposit rates will actually has as a consequence less people to find the borrowing profitable, because as interest rates increase, less people will want to borrow, right? Because the higher the interest rates are, that means that they will, once they borrow from the bank, then they will have to repay the bank back more than before. So as the interest rates increases, then the people will not really want to borrow from the central bank. So the lending um, power, if you prefer, it will decline. So reducing the amount of lending is expected to stabilize with this way the amount of money in the economy and ease any inflationary pressures and cool down the demand side of the economy. Okay, so that's why this is one tool for stabilizing the economy and um, uh, for keeping stable the inflation if it's getting too high. So one way is by reducing the amount of lending um, by increasing interest rates. Okay, Okay. Before we move on how they affect the trading, let me go through the opposite example. So this is the increase of interest rate is it implies to a restrictive monetary policy, a tightening of monetary policy. Okay. So this will be put to use when economic growth is robust and there is a real risk of runaway inflation. So we're seeing a increase of rates, which making the borrowing more expensive and put a damper on rapid growth to keep it in check. Now, the opposite scenario, when we have a accommodative monetary policy, is when the bank decide to lower the interest rates. And this is when we are seeing the borrowing power to increase. Okay, so this is called also expansionary policy. So the expansionary policy of buying market assets is a combination of very low interest rates, so that attracts investors, attracts borrowers, and that as a consequence boosts stock prices because investors find it easier to borrow, and therefore they are purchasing assets, services, and etc. So the accommodative policy, the lower interest rates, is attracting investors because they have a really low relative cost. Okay. So it's the exact opposite thing of what we have said earlier about the restrictive monetary policy. So let's move on. Guys, are you here? Are you following? There are no questions and I'm starting to worry a bit. So how central banks affect trading? Let's move on. So, okay, perfect. So, um, so how they affect the markets? They affect the markets using the interest rates. So we'll get back to the interest rate. Remember, as we already mentioned, that the higher the interest rates are, this means more return in the currency, right? So in general, the changes in the interest rates have both positive or negative effects on the market. So um, so raising interest rates when the economy is overly strong means more return in the currency. Lowering the rates when the economy is sluggish means less return in the currency, right? So if, for example, in Europe, the ECB is having a zero interest rates, okay, zero in the deposits, and in the United States they have 2% interest rates. So that means, guys, that if you deposit money in the United States, this is more profitable than depositing your money in Europe, because by investing your money into US, it will give you a 2% return. But if you invest your money into Europe, you won't have a return. So it is more profitable to put more money in dollars than in euros. So that means that US is attracting investors, right? Simply because it has higher return, and this means that uh, there will be more demand of dollar and less for euro. Is this clear? Okay, so it won't, dear Udo. increasing interest rates, it will, so it depends what you are referring, are you referring to the overall economy, or particularly to the currency of a country? Because the increase of interest rates tends to appreciate the currencies of the country, but to negatively affect the corporate section, so the stocks, the corporate stocks. Let me know, okay? So in this case, guys, since it's more profitable to invest our money in dollar in the United States than in euro, so that implies, as we said, more demand of dollar than and less for euro. What does this means for euro dollar cross? Does anyone is aware of that? Yes, I will try, William. I will try, okay? At least verbally, I will try. Does anyone know how this will affect the euro dollar? Anyone? Exactly. Sell euro and buy dollar. Exactly. So that will imply to euro dollar moving lower. So let me just, this is dollar index. Come on, where is my euro dollar? Okay. So as I said, this will imply to euro dollar moving lower. So we're gonna have a stronger dollar due to the high demand, and a weaker euro due to the less demand. So before we see some examples, I would also like to touch a bit the how the forward guidance, how the statements from the central banks can also affect the markets. Okay, so that these are the just two statements with 1 month difference, and I would like you to tell me which of the two is more pessimistic than the other. Okay, so the very first one, it says risks to the economic outlook appear roughly balanced. The second one says the committee judges that risk to the economic outlook are roughly balanced, but will continue to monitor global economic and financial developments and assess their implications for the economic outlook. So which one sounds more pessimistic than the other? More negative than the other? Anyone? Anyone? Come on, come on, come on. I'm afraid not, guys. The very first one is more pessimistic, negative than the other, because it's too generic, while the other says that even though the risks to the economic outlook are roughly balanced, we will um, sorry. Yes, you're right, actually. Wait a minute. You said that the more pessimistic is the second statement. Yes, sorry, you're right, you're right, you're right, you're right. Yes, the more pessimistic is the second statement, and we can see this affecting immediately the dollar, because this is something that came out from the Fed. So on this announcement, on that statement, and in general on the economic data, we've seen the dollar appreciating based on that statement, because that statement stated that the risks are balanced, right? So that was wait a minute. You said statement 1990. Yes, I asked for more pessimistic, not more optimistic. Okay, so optimistic one was the very first one. More pessimistic, you're right, it was the second one. So that's why on the very first statement, we have seen the dollar boosting higher. Boosting higher, this is in 1 hour chart. on the 8th of November, and we're seeing jumping higher because with this statement we could see that they somehow have the risk under control. But with the second statement, let's move on to see the second statement. Come on. Here we are. The statement from the Fed started to add worries into the market attendees because he mentioned that even though the risks are roughly balanced, come on, let's get back, are roughly balanced, we will keep monitoring the economic data and assess our economic outlook. So that added a bit of worries in regards to the forward guidance of the central bank. That's why we've seen the markets negatively affected after that announcement, and with the dollar moving lower and lower. So this is how the speeches, the monetary policy meetings could affect this announcement from the central bankers, could affect positively or negative the markets. Okay, and I would like to add something. So have in mind that the central bank meetings are important because they're giving us hints, as we said, for the forward guidance of each central bank, for each central bank. So that is giving us a hint at what they are about to do next. So with this way, we can it give us a hint on the expected movement of the country's currency. That's why the central bank meetings are of importance, and they are the high volatile events as well. Okay, so um, so for example, let's see nowadays what's going on. Next week we have Fed. Okay, we have Fed next week, but I would like to remind you that the Fed has already increased rates this year several times, and now they went even more aggressive than before, and they have actually gave a sign. Actually, they clearly stated that they might proceed with even more aggressive monetary policy in May. So that's why, and actually it was a clear statement. I think it was a statement from Fed Williams. He said that a 50 points in rate interest is very reasonable option. We had Bullard as well, also supporting up to 100 points increase. We had the FOMC minutes in the beginning of April as well, saying that 50 points hike is necessary. So all these hints, okay, all these comments from the members of the central bank have affected the dollar. That's why if I put my MT5, MT4, sorry, dollar index, I put the daily chart on, and the reason why I put the daily chart on is because I want to show you that it's keep moving higher and higher. But if I just zoom in at the dates of the announcements of these speeches, so on the 6th of April, where is the 6th of April? You see over here we had another increase because it's when the FOMC minutes came out and hinting that another 50 points are expected. On the 7th of April as well, it continued moving higher, not significantly, but it continued higher. It was when the Fed Bullard said that 100 points increase is needed for in the long term on the 14th of April. So over here, it was when William said that 50 points is necessary. Let's get back on the beginning of April here. These 4 days we have seen Brainerd speaking. We have the Evans speaking as well, George speaking as well. All of them suggesting, actually clearly stating that rates needs to increase, and that got a boost on the dollar even further. And with this way, I'm trying to make you understand how the Federal Reserve, the meetings, the comments from the members of the central bank affect the asset. Why? Because higher interest rates, even though they just signaling that we they are saying that they are they're saying their opinion, right? They're saying that I believe that we need to increase rates by 50 points. We need to increase points by 100 points. They're just saying their opinion. But this, even if they say just their opinion, they are giving us, they are increasing the expectations. They're increasing the expectations of the market participants that the Fed will increase rates, because these people are members of the Fed. So by saying that we want 50 points hikes, we want 100 points hikes, then they are boosting the dollar higher on the anticipation of higher interest rates. Even so, that's why we are seeing dollar increasing for the whole year, for the whole 2022. That was on the anticipation of tighter and tighter monetary policy, on high of increase of interest rates. Coco, yes, the second statement was bad. Yes, you're right. Yes, you're right. So this is the current dollar, and as you can see, the dollar has been is on the upside for the past 4 days, because next week we have the Fed. The Fed is expected next week to increase by another 50 points its interest rates. Okay, so ahead of the Fed, we are seeing the dollar being appreciated, because as I explained, the higher the interest rates, okay, the more expensive the borrowing will be, okay? The more expensive the borrowing will be, but the higher the, where is it? Let me just put the slides on. We'll skip a bit the quantitative. So the higher the rates, the less the spending, okay? But the higher the value of the currency. And because you asked me, William, what's the relationship to the bond yields and to the stock trading? So positive, the higher rates implies to boost of the currency market, but pressure on the stock market. Okay, because it is no longer is no long it doesn't sorry. So higher interest rates imply to appreciation of the country's currency. So in this case, let's assume that we're referring to the Fed and to the US dollar, okay? Because we have next week the Fed, so it's a good example, okay? So that implies to um, uh, pressure on the stock market, okay? Pressure to the stock market, and a boost on the bonds as well. So boost on the currency, boost on the bonds, but pressure on the stocks. Is that clear, William? If not, let me know, guys, okay? In general, even though the stock market is affected by many factors like politics, assumptions about the future of a company, affected by news, by weather, and in general. In general, you should know that the interest rate, if the interest rates increase, the stock market will go down. When interest rates go down, the stock market will go up. Okay, this is because the interest rates affect the consumer and business spending. So as I'm writing over here, the higher the rates, the less the spending for the consumer. That's why this is negative for the corporate stocks. Okay? Yes, if I get you, higher yield simply means higher interest rates, so the interest rate effect, oops. Yes, that's correct, William. So that's why have in mind what's going on this year with the Fed, okay? Have in mind what's going on with the Fed. The higher the interest rates or even the anticipation of higher interest rates support the dollar index, right? This is the daily chart since January 2022. And if I put come on, let me find the stocks as well. Come on. Where is it? Where is it? Okay. This is the yields, right? This is the bond, the yield, sorry, down. And this is the stocks. Stocks. Let's have Nasdaq for example, or S&P. Where is my S&P? Where is my S&P? Should have been somewhere here. Yep. Let's have a daily chart of S&P, zoom out a bit, and you can see that it had a big dip the very first 3 months of 2022, a bit of appreciation due to the war in the late March, but continue to the downside again due to the Fed. So it's logic. Remember that the more the interest rates, right? We said that the less the spending because it's more difficult for the people to borrow money, so they try not to spend a lot of money. So that affects immediately um, individual companies. Okay, because people are being discouraged for spending money. Okay, so that means that homes cost more to buy for individuals, and borrow money to finance businesses operations becomes more costly. So that has a negative correlation with the stocks. Okay. Okay, let's move on to the next question. So let's get back. I will reply as Abudo. Let me get back to my slides. Do I have so come on. Okay, I'm gonna reply. Okay, I'm gonna reply first to Udo before I move on to the quantitative easing. Okay. Just let me find where we left it. Come on. Okay, we have seen the statements over here. Fair enough. Okay, so Udo is asking. Let me just okay, ignore these slides for now until I reply to Udo's question. So it's a similar question with William as well. So Udo is asking how does high interest rates affect bond and futures? Okay, so okay, let's take it step by step, and I'm gonna put my MT4 as well on. And I want the S&P 500, and I want the dollar, the USA 10-year bond as well. Okay, here we are. This is a daily chart. Give me a second, guys. So, okay, here we are. Perfect. Okay, here we are. So I'm gonna start with the bond. Okay, gonna start with the bond. So remember that interest rates actually Okay. First of all, let's clarify something. What the bond futures are. Okay. Bond futures, okay, are actually contracts, a contract that has been purchased by someone. Okay, actually it's a contract to purchase or sell a bond on a specific date and a predetermined price, right? Right? Okay, so far. So a bond, okay. Actually, I'm gonna confuse you if I'm say something like that. Okay, let's simplify things. Okay, we have the treasury bonds, right? So in this case, we have the US 10-year one. Okay, the 10 years, the 10-year one. So that means that it will expire in 10 years. So it's a governmental bond. First of all, is a bond that has been, is a debt security that has been issued by a government. So in this case, the United States. All right, in order to support the government spending and obligation. Okay, so if I, as Andrea, buy, for instance, and purchase a government 10-year bond, then this bond can pay interest rates back to me, okay, called coupon payments. Exactly. So, okay, so far. So it's been issued by the United States, US state governments. It can be purchased by individuals, and it gives them periodic interest payments back based on the interest rates. Okay. Okay, so far. So if a government has high interest rates, okay, that means that the higher the return will be for the person that has purchased the government's bond. The lower the interest rate, then that means lower return for the investor. That's why they are positively correlated with the interest rates, with the central bank's interest rates. So the 10-year one, for example, is used as a benchmark and a guidance for interest rates on lending products. So the lower the interest rates get, the lower the return will be. The higher the interest rates get, the higher the return will be for the corporate, the governmental bonds. But in this case, okay, so is that clear, Udo? Not really, right? No? Let me know if you need anything else. So bond yield is proportional. Okay. So yes, wait a minute. So let's clarify something. We have bond prices and we have yields. Two different things, right? The are we clear with the difference between yields and bonds? So a bond, okay, is the rate of interest it pays, it pays annually, but the yield is the rate of return it generates. So they are two different things. So the bond yield is based on the bond's coupon payments divided by its market price. So it's a derivative, we could say, of the bond. Okay, so as bond price increases, bond yield falls. So just to summarize, because I think I'm going to confuse you. So what you need to have in mind is that the higher the interest rates are, okay, the higher the interest rates are, the higher the yields will be, but the lower the bonds will fall. So, okay, let me draw something. Let's go to the, so how it affects the markets. Let me draw it here so you can see it and save it. Pen. So interest rates, higher interest rates imply to strong dollar. Okay, if we are referring to higher interest rates from the Fed, okay, just an example, just to memorize the how it affects the market. So the higher the interest rates, the stronger the dollar, the stronger the yields, okay, the yields, the lower the bonds, okay, and the lower the stocks, because less spending, as we said. Now, the lower the rates, then everything vice versa. The lower the rates, the lower the dollar, the lower the yields, the higher the bonds, the higher the stocks. Is it now clear? Yes, okay. Remember, in order to manage to memorize this, remember that a monetary policy, right, a change in the interest rates, okay, defines the risk-free return rate of return, okay. So, and this risk-free rate of return it has a large impact on the demand of bonds, stocks, yields, currencies. So, and why the bonds have the bonds have a different reaction from the yields? Simply because a yield, okay, is based on the bond payment divided by the market price. So as bond prices increases, bond yield falls. Okay, the yield equals with the annual coupon payment over the bond price. That's why they are negatively related. Because let's assume that, let's have an example actually, just to make it clear. Okay, let's assume that we have $1,000 bonds. Okay, this is MB bonds, and it has every year this bond is giving to the investor $100 payment. Okay, so, and it's selling near par, is selling is for 110. Okay, 110. So its yield equals, sorry guys, it's very draftly. Let's assume that is 9.9%. So that means that we have the 100, which is the coupon payment, over the 110, which is the selling. So that implies to, come on, let's do the maths. So that was the 9.9. So that means that if the selling right? If the bond price increase, if the bond price increase, right? If the bond, this is a bond price, okay? If the bond price increases, assume that the bond price goes to 10.20, it has increased. The yield then will be equal to 8.3%. So the higher the bond gets, the lower the yield goes. The lower the bond goes, the higher the yield, because the yield is equals with the coupon payment divided by the bond price. Okay, I don't want to go further in depth of it because it's getting lengthier and lengthier. Just stick on what I just mentioned on how the interest rates affect the market. As I said, this is the main thing to remember. Higher, it means stronger dollar, stronger yields, lower bonds, lower stocks. Lower rates is the vice versa. More spending, so that depreciate the value of the currency, depreciate the yields, appreciate bonds, appreciate stocks, because people tend to spend more and to buy more stocks, more services, more goods, and etc. And just let's get back to where we have been, and let's see also another tool that the central banks are using for controlling the economy. So and let's have a look on the. Here we are. We have spoken a lot about interest rates, so now let's move on to the quantitative easing. Okay, quantitative easing. It refers, okay, it refers to the action or to the it's a form actually of monetary policy in which the central bank purchases long-term securities, okay, in order to increase money supply and to encourage lending and investment. So what the central bank is doing is like buying securities in order to add more money, add more new money into the economy, so the economy will move on. Okay, so they tend to, if the economy is struggling, they tend to do that in combination with lower interest rates. Okay, so with this way they help the expansion of central bank's balance sheet. Okay, so quantitative easing is pretty much the increase of the supply, the money supply into the market, but by purchasing assets with newly created bank reserves in order to provide banks with more liquidity. Okay, so the reason for that, what they trying to do with that is to inject liquidity, inject more new money into the economy, okay, in order to help help the economy into the short term, okay. So that's how they have. This is what the central banks have done since the pandemic. So due to the economic shutdown that we have seen from the pandemic, but since the March 2020, all the central banks, all of them, I don't remember any of them that hasn't proceeded with something like that. All of them try to inject the economy with new money. Okay, and one way to do that, they have announced an enormous amount of quantitative easing plans. So, for example, the Fed had announced a 700 billion initially, more and more have been added afterwards, but initially they have announced a quantitative easing plans of over 700 billions. Afterwards, he extended even more its program by purchasing another 80 billion in treasuries. Later on, it purchased another 40 billion or more mortgages, securities. All of the central banks, in order to face the economic shutdown from the COVID-19, it proceeded with the combination of quantitative easing, so um, purchasing of long-term securities in order to increase the money supply into the market, along with low interest rates. So this is one way to help the economy. But how does this affect the forex market? Pretty much with the same way that it affects the interest rates. So the more the money injected into the market, the less the value of the particular currency will be. So, for example, over here we have euro dollar. So this is an old example, but it's the same exact thing as the same exact reaction as the ones that we have seen the past 2 years. So back in September 2018, Draghi, the president back then of the central bank of the ECB, said that they will reduce the money pace of the net asset purchase to 15 billion until the end of 2018, and then end the net purchases. So what that means? It means that they want to end the quantitative easing. So the end of the quantitative easing, okay? Let me just. On this announcement, we have seen the euro dollar drifting lower. Okay, so drifting lower, that means that euro got weaker than dollar. So let me move on. How can I clear? So it's the same exact mentality as the rates. Okay, if the central bank announce asset purchase, quantitative easing as an emergency measure, okay, that means that we're gonna have a massive amount of money boosted in the economy, right? So this has a negative um, um, affection, a negative impact into the markets. But if they announce the end of the quantitative easing, that's the vice versa scenario. Okay. So let me clear all of this mess in order to find to explain let me clear all this mess over here just to write down how the quantitative easing affects currency market, yields, bonds, and stocks. So let me clear all of this mess. Just give me a second, guys. Erase all link on slide. Perfect. So, okay. So now we have checked how the interest rates affect. Let's go to the quantitative easing. So quantitative easing. We're going to finish with that because it took too long. We're already an hour and a half nearly live. So we said that quantitative easing not always coming into to combination with interest rates. So quantitative easing is coming to force along with lower interest rates. Okay, so central banks, if they are about to set a more accommodative monetary policy, they increase their quantitative easing and they are pushing the interest rates lower. Okay, so that lowers the returns of investors. Okay, and that's why the investors get to shift their money into um, into relatively riskier investments in order to find stronger returns. Okay, so that's why we have the exact similar idea with the interest rates. So if the central bank is increasing the quantitative easing, so they putting more and more money into the economy, okay, then this has as a consequence lower currency. Let's put dollar again as an example, okay? Depreciation of the dollar, depreciation of the yields, but boost on bonds and boost on, on stocks. Because the fact that there wasn't depreciation of the currency then means that the people are now having more and more spending power, so they can purchase services, goods and services, and etc. So so it's the exact same idea as the increase or decrease of the interest rates. Are we good so far, guys? Because actually I'm gonna call it a date. And an example could be euro dollar, even though because they have extended the quantitative easing with Lagarde. Let me find the exact announcement, the date of the announcement, but also we have the dollar, which they increase interest rates and they keep increasing interest rates. But for example, in the ECB has announced the end of the quantitative easing after March. So by the end of the March, that was supposed to have a positive impact on euro, but because we have the Fed increasing rates, that's why we keep seeing euro dollar moving lower, because despite of the end of the quantitative easing, on the flip side, this is a euro dollar cross. On the flip side, we have the fact that is keep increasing interest rates, something that is dollar positive. Okay, while on the other hand, euro it kept the rates unchanged at the 0.50%, negative 0.50%. But if ECB was about to follow the same path as Fed, then we would have seen some appreciation of the euro, but we cannot really see that, as I said, because of the aggressive Fed. So we're good. Thank you for the detailed explanation. My pleasure, dear Udo. I'm trying to figure out whether I forgot something, but I think the most important things have already been stated. So I'm trying to find, I have an example. Let me just find it and we can call it a day once I show that example. Yeah, we have seen that. So on the 14th of June, 2018 is when we'll reduce the monthly pace of the net asset purchase to 15 billion and then net purchases, but this is when it was initially got a decline, but then boosted afterwards. So it's not a very good example, however, not a very good example. Trying to find a good example in which the end of the quantitative easing will show the boost of interest rate of the boost of the currency. But what you should focus other than the quantitative easing is the interest rates. So sometimes it's not just the announcement of the end of the quantitative easing that it will boost the euro, for example. It's also a hint or a clear statement by the central bank that they will also increase the interest rates. Because if they just mention, like Lagarde did last time. If they just mentioned that, oh, we're gonna end the quantitative easing, but we won't gonna change the interest rate, we're gonna keep the interest rate at 0.50%, negative 0.50%, then you will not probably see the asset, the currency being appreciated. And this is the case over here as well. And this is the case with euro nowadays. Even though Ms. Lagarde said that by the end of March we're gonna end the quantitative easing, she didn't change the interest rates. That's why, guys, we keep seeing the euro moving lower, because from the euro ECB side, we don't have any change on the interest rates. So if I can say that, the interest rates are a bit more important than the quantitative easing. That's why you need to be careful and try to monitor the statements from the central bank, but as a whole, not focusing only on the quantitative easing, but also on what they have to say about the interest rates. Because interest rates are the ones that have an immediate impact and a more volatile impact on the stock market, forex market, currency market, equity market, and etc. Okay. So that was it from me. It's a very, very theoretical, I'm afraid, webinar. If you have any question, now is the time to give it a shot. I will reply right now. If not, we can call it a date. And yeah, if not, we can call it a date. And anyway, for any questions that you have, anytime, regardless of the webinar, of the topics that we are providing in the webinar schedule, feel free to send us an email with your questions, with anything that struggles you, and we will reply as soon as possible. So 10, 9, 8, 7, 6, 4. Oh no, 6, 5, 4, 3, 2, 1. No, thank you so much, Tunte, for your kind words. Anything you need, guys, feel free to send us an email at webinars@hotforex.com. Thank you for attending. Hope you're having a great day ahead. And I'll see you again tomorrow. So tomorrow we have actually a related topic: carry trade and carry trade strategy. Okay. So yeah, gonna see some carry trade or some strategies based on the carry trade, on the difference, on how we can, how can I say that? How we could take advantage of the yield differentials. Okay, that's a better way of saying it, between the two currency pairs and etc. So thank you very much. I'll see you again tomorrow. Bye bye.